Let's talk about inflation, one of the most important forces shaping our daily lives, even if we don't always notice it right away. But what does inflation really mean for your wallet, your savings, and your future plans? Think of inflation as a slow leak in your financial life. It quietly erodes the value of your money, making each dollar buy a little less as time goes on. You see it every time prices rise, at the grocery store, the gas station, or even when you grab your morning coffee. Suddenly, your usual purchases cost more, and your paycheck doesn't stretch as far. The Consumer Price Index, or CPI, is the tool experts use to measure inflation. It tracks the changing prices of a basket of everyday goods and services, from food and fuel to clothing and healthcare. When the CPI goes up, it means your cost of living is rising. Families feel the pinch as bills grow, and retirees worry about stretching their savings. If your savings or investments aren't growing faster than inflation, you're actually losing purchasing power, even if the number in your bank account stays the same. Even getting a raise at work might not help if inflation is higher than your pay increase. It can feel like you're running in place, or even falling behind. The CPI report is like a financial report card for the economy. It tells you how much more expensive life has become, and helps you plan for the future. This single number influences interest rates, the stock market, and even the decisions made by central banks. It shapes your financial future in ways you might not expect. Ignoring inflation and the CPI means risking your financial security. Without understanding these numbers, you could be caught off guard by rising costs. So, take the time to know the numbers, understand how inflation works, and protect your money for the future. Earlier this year, inflation cooled off. Headline rates dropped from 3% to 2.3% by April. Core inflation, which strips out food and energy, also hit a 4-year low. It felt like relief was finally here, and hopes for lower interest rates grew. But don't get too comfortable. This calm may be temporary. Powerful forces could reverse the trend this summer. The reason isn't a suddenly overheating economy. It's a technical detail in how inflation is measured. Don't assume the inflation fight is over. Be ready for surprises in the months ahead. Let's break down a crucial concept in understanding inflation, the base effect. This term gets thrown around a lot in economic discussions. But what does it really mean, and why does it matter so much right now? Inflation is typically measured year over year, which means we compare today's prices to what they were exactly 1 year ago. This method helps us see how much prices have changed over time. But it also means that what happened last year can dramatically affect the numbers we see today. If last year's prices barely changed or even dropped, then any increase this year, no matter how small, can make the inflation rate look much higher than it actually feels in your day-to-day life. For example, in May and June, last year's inflation numbers were unusually low, or even negative, due to unique economic circumstances. This sets a very low base for comparison. So when prices rise even a little bit now, the annual inflation rate jumps sharply. It's not that prices are suddenly skyrocketing, it's just that the math makes the increase look bigger. This is why economists call it a statistical illusion. The numbers seem alarming, but they're being distorted by last year's unusual data. So when you see headlines screaming about rising inflation, remember, it's often just a quirk of the calendar and the way we measure changes over time. The Federal Reserve and most economic experts are well aware of this effect. They look past the headlines and dig into the details, but most people only see the big, bold numbers. So don't panic when you see those numbers jump. Take a breath and remember that context matters. The real trend in prices may still be stable, even if the annual rate looks volatile for a few months. Understanding the math behind the headlines helps you see through the noise and focus on what's really happening in the economy. Stay focused on the bigger picture, and don't let short-term data swings distract you from long-term trends. Remember, the data can be tricky, so always look deeper before drawing conclusions. So, what's expected now? As we look ahead, financial experts are closely watching the latest data and trends, trying to predict what's next for your wallet. The economic landscape is shifting, and everyone, from Wall Street to Main Street, is bracing for what could come. May's CPI is forecast to tick up to 2.5%, and core CPI to 2.9%. These numbers might seem small, but they're significant signals for the economy, and they're being watched by policymakers and investors alike. It looks like inflation is heating up, but you know it's mostly the base effect. That means last year's unusually low numbers are making this year's increases look bigger than they really are. June's report will likely show an even bigger jump for the same reason. Experts warn not to panic, but to pay attention to the underlying trends, not just the headlines. But there are real risks too. If inflation keeps rising, it could start to affect everything from your grocery bill to your mortgage rate. Stagflation, rising prices, and a slowing economy is a concern. This rare combination can be tough to manage, and it's something economists are watching closely. Higher business costs and a weaker dollar could push prices up for real. When companies pay more for materials and labor, those costs often get passed on to you, the consumer. Trade tensions and tariffs could add more volatility. Disruptions in global supply chains and new tariffs can make everyday goods more expensive and harder to find. It's not just math, global events matter. Political decisions, international conflicts, and even natural disasters can all impact inflation and your cost of living. Watch for changes in the dollar and trade news. A strong or weak dollar can change the price of imports, and new trade deals or disputes can shift the economic outlook overnight. The picture is complicated, but you can stay ahead by staying informed. Following reliable news sources and understanding the basics of inflation can help you make smarter financial decisions. Don't get caught off guard. Stay alert, keep learning, and you'll be better prepared for whatever comes next. What will the Federal Reserve do? Their job is to keep inflation near 2% by adjusting interest rates. Even though the summer inflation bump is mostly statistical, the Fed can't risk cutting rates now. Rising inflation headlines make it hard for them to act. Markets expect no rate cuts soon, maybe not even by July. The Fed will wait for clear, lasting progress before making loans cheaper. So, what should you do? Accept that higher rates are here for now. Pay down high-interest debt, watch the data, and don't panic over short-term bumps. Stick to your financial plan, save, invest, and control what you can. That's how you stay strong, no matter the forecast.